Welcome back, friends. Today we are discussing a topical subject, the significant changes the federal government has proposed concerning capital gains exemption limits. Let us understand these changes and explore their impact on us as individuals and as corporations. Before we begin, let us clarify the concept of inclusion rate. This rate determines the portion of capital gains on which tax is payable. The upcoming changes affecting both individuals and corporations are set to take effect on June 25th, 2024. Currently, homeowners selling their primary residence enjoy a complete exemption from capital gains tax, a policy that will continue unchanged. However, for second properties, or if you will, investment properties, so the current inclusion rate means that half of the gains are taxable and they are added to the individual's income for that given year. This is changing. Let us understand how. Under the new regulations, the inclusion rate for individual taxpayers will increase to 66.7% for gains exceeding 250K within a year. Gains up to 250K will remain at the 50% inclusion rate level, which is as of today. Let us look at two example scenarios and it will make things crystal clear to you. Imagine an individual who bought an investment property for 450,000 in 2010 and is now selling it for 750K, realizing a total gain of 300,000. 50% of 250,000 is 125,000, and 66.7% of the balance 50,000 gives us 33,333. Under the new rules, if they sell after June 25th, they will have to pay income tax on 158,333 compared to 150K under the current rules. In our second example, consider someone who bought an investment property in 2004 for 250K and is now selling it in July of 2024 for 800,000, realizing a total gain of 550K. 50% of 250K gives us 125K, and 66.7% of the balance 300,000 gives us 200,000. So the total taxable gains under the new rule will be 350K as compared to 275K for the currently taxed. Assuming effective tax rate of individual as 31%, the new tax liability on the gains would be 108,500 compared to 85,250 previously. So a difference of 23,250 on gains of 550K. This second example brings the point home and makes it pretty clear that the changes introduced or effective from June 25th are not that critical how they sound to be when you initially review them and hear in the news portals and outlets. For corporations and trusts, the inclusion rate for all capital gains on asset sales will be 66.7% and applicable to all gains realized on or after June 25th, 2024. Clearly, it is a more impactful change for corporations. Now let us understand how this impact real estate. With the announcement of federal budget on April 16th, the real estate market had experienced a bit of slowdown. While the direct impact of these changes may seem minimal, it will take time for the consumers to fully absorb and adjust to these new regulations. The policy shift has undoubtedly dampened market sentiment, already weakened by slow economic conditions over the past couple of years. Such changes in policy timing could be debated for their effectiveness. With the imminent rate cuts, this could have been implemented a little later in the year to allow market to settle itself and stand on its feet. I encourage you to share this information with friends and family who might benefit from understanding the calculations behind these new rules. Also, feel free to comment on any real estate topics you would like us to cover next, and we will surely do. Thank you for tuning in, and I look forward to connecting with you soon. Have a great day. Take care.